So in this video, I want to walk us through the process of allocating fixed costs or corporate costs to individual segments. This is a tricky area because corporations will often want to allocate their fixed costs to the individual divisions to get a feel for how profitable the divisions are when they're absorbing some of the fixed or overhead costs. However, there's a dilemma in that those individual divisions really don't have control over those costs. So to evaluate them based on operating income after an allocated cost can be tricky. And so there are a number of ways that corporations may approach it. Some may allocate some costs, not others. Some may not allocate costs at all, and some may allocate all costs. So that's the first issue. Do we allocate or not allocate? Then you've got the question of, if we allocate, what do we use as our allocation base? As we've talked about in the past, we want that allocation base to reflect cause and effect as much as possible, but there's a trade-off between complexity as well. So what I want to do is just walk through this particular example as an sample of the process. In this example, we have 4 divisions: the Acme, Dune, Stark, and Brothers. And by the way, this is a problem in your textbook 14-22 if you want to take a look at it. So we have revenues for each division, then direct costs, and by direct costs, I mean costs that are directly tied to that division. They have control over them. If that division went away, those costs would go away. And then the segment margin. Segment margin is the amount of profitability that is being contributed strictly by the revenue and direct costs of that particular division. So we have that information for each of the divisions. Then just some additional information: the number of employees that each of the divisions have, and total fixed costs. So this 16.8 million is the amount of costs that we are trying to allocate to the divisions. So again, determining what your allocation base should be is a key factor in this process. So just to see how the allocation base can impact the amount that's allocated, we're going to walk through 4 different approaches, or 4 different allocation bases. First, we're going to allocate based on the revenues of each division. Then we'll allocate based on the amount of direct costs. Then we'll allocate based on segment margins. And then lastly, we'll allocate based on number of employees. Each one has a different assumption. So in the first scenario, where we're allocating on revenues, I would argue this is what we would call an ability to bear approach. That the assumption being the division with the highest amount of revenue should carry the highest amount of fixed cost. So what we're going to do is, if you go to the allocated fixed overhead line and look at the formula I've put in, what I have done is I've taken the amount of revenues for Acme, divided it by the total for all divisions, and then multiplied that by the fixed costs. And if you walk across, I've done exactly the same thing for each division, thereby allocating fixed costs based on the proportion of revenues for that division to total revenues. Then I've come down to division operating margin, which is merely the segment margin minus the allocated fixed overhead. And if you walk across, you can see that Brothers is hit very hard with this approach to allocation. They have a high level, you'll notice, of direct costs, which means their segment margin, even though they have revenues, their segment margin is not sufficient to absorb the amount of overhead that we allocated. This last line item is just the division operating income as a percent of revenue. Yet another way to evaluate the profitability. Okay, so in the second scenario, we're going to say, well, no, revenues shouldn't be the allocation base. We're going to allocate fixed overhead based on the amount of direct costs. Idea being the more direct costs you have, the more you make use of the corporate overhead or the fixed costs. So same scenario, if you go into the formula, I'm taking now the direct costs for Acme divided by the total times the fixed costs. And then if you walk across each division, I've gone through exactly the same calculation for each one. And now notice what's happened to Brothers. Because of that large amount of fixed overhead or direct costs they have, they're getting hit with a significant amount of fixed overhead, thereby increasing the amount of loss that they are going to absorb. Now, one thing I want to make sure you understand, notice that the individual operating margin of each division is changing under these different allocation methods. The total operating income for the company is not changing. We're not changing their profitability of the overall entity. We're adjusting the profitability of each individual division based on how much of the fixed overhead they're getting. Now, in the third scenario, we're going to, again, I would say, use an ability to bear approach. In this case, we're not going to look at revenues. We're going to look at, okay, what's the segment margin of each division? And based on that, how much of the fixed overhead can they absorb? And so, again, we go into the formula, and what I am doing is taking the segment margin divided by the total and times the fixed costs. And now notice what's happening. Brothers is in a better position because the segment margin that they are showing is much lower, and so they're getting a lower amount of the fixed overhead. The very last scenario is where we focus on an allocation base which represents number of employees. Here we're actually saying there's a cause and effect between the number of employees that each division has and the amount of overhead they incur. So they should be allocated. So what we're basically saying here is that most of the overhead must be somehow tied to the number of employees that are working for that division. And so again, we're going to take, in this case, the number of employees by division divided by the grand total times the fixed overhead costs. And now we're looking at a very different picture. Notice who, in this scenario, Brothers is making out really well because in the overall scheme of things, they don't have that many employees. So if the allocation of fixed overhead is going to be based on number of employees, Brothers is going to be happy. That is what's best for them in terms of profitability. But I caution you again on the appropriateness of evaluating a division based on this operating margin unless the allocation of the overhead makes significant cause and effect sense, because otherwise the division is being evaluated on something over which they have no control. And then we get into the whole concept of responsibility accounting and if I'm going to be penalized because I'm getting a larger chunk of overhead and I don't have the ability to control that, there's going to be a problem. Now, obviously, if we're looking at brothers, if they controlled their direct costs better, then they might be more able to absorb the amount of overhead that's being allocated to them. So there is that argument, but nonetheless, in the first couple of scenarios at least, they're being put into a loss mode strictly because of the amount of overhead they're being allocated.